The Quiet Ruin, Greenwich, Connecticut, October 2008. On Round Hill Road, where hedge fund managers once hosted summer parties worth more than most people's retirement accounts, a 62-year-old former vice president of structured products stood in his driveway. His suit was still tailored. His watch was still Swiss. But the bank had sent a courier that morning. Not a letter, just a single sheet of paper. His margin call was due by noon. He had no cash. His portfolio, once $9 million, was now worth less than the paper. The notice was printed on. By the time the leaves fell that year, he had lost the house, the marriage, and, for a brief period in November, the will to answer his phone. This was not a story from the newsreels of foreclosed factory workers. This was the quiet apocalypse of the American millionaire class. The popular imagination of 2008 is crowded with images of Lehman Brothers employees carrying boxes onto the sidewalk, Main Street suffering because of Wall Street's greed. And that narrative is true for the bottom 90%. But what happened to the top 1% during the crash is a different kind of tragedy, less visible, more ironic, and far more instructive. Here is the myth most documentaries sell you. Millionaires saw the crash coming, moved their money to cash, and bought distressed assets at the bottom. The rich get richer. End of story. That is almost entirely false. What actually happened to millionaires during the 2008 financial crisis was a systematic wealth incineration engineered by the very instruments that had made them rich. And understanding that process requires unlearning almost everything you think you know about how wealthy people lose money. Consider the case of the Palm Beach condominium flipper. In 2005, a retired cardiologist with a net worth of $4 million sold his practice and reinvested the proceeds into pre-construction luxury units. By 2007, his paper valuation had doubled. He was attending charity galas as a major donor. He had a second home in Asheville. Then the adjustable rate mortgages on his spec units reset. Interest payments tripled, buyers vanished. By March 2009, his lender seized 4 of his 6 properties. He declared Chapter 7. His entire wealth had been built on leverage against future appreciation, a bet that worked for 30 years and failed in 12 months. This pattern repeated across every asset class that wealthy Americans trusted. The first structural misunderstanding is liquidity. Most millionaires in 2008 were not sitting on piles of cash. They were asset-rich and cash-poor. Their wealth existed as stock portfolios, real estate equity, private business ownership, and, most dangerously, margin accounts. When the market fell 20%, they received maintenance calls. When it fell 40%, those calls became demands. Many were forced to sell at the worst possible moment simply to meet lender requirements. The wealthy did not sit out the crash. They were forced to participate in it. The second misunderstanding is diversification. The conventional wisdom says wealthy investors spread their risk across sectors. But in 2008, correlation went to 1. Everything fell. Real estate, equities, commodities, even supposedly safe municipal bonds. The only assets that preserved wealth were cash, gold, and direct ownership of productive land. And very few millionaires held meaningful positions in any of these. Here is a numbered framework for understanding exactly what happened to millionaires in 2008. Use this as your structural map. 1. The leverage trap. Millionaires who borrowed against their portfolios to fund lifestyle or additional investments faced margin calls that wiped out their principal. Leverage amplifies gains in good years. It amplifies losses in bad years. 2008 was the year leverage turned into a reverse wealth accelerator. 2. The illiquidity premium became an illiquidity penalty. Private equity stakes, hedge fund lockups, and real estate syndications, all marketed as higher return opportunities, become impossible to sell when everyone else is trying to sell. Many millionaires watched their net worth evaporate on paper while being legally unable to access whatever remained. 3. The high-fee portfolio trap. Wealth management firms charged 1 to 2% annually for portfolios heavily weighted toward financial sector stocks and mortgage-backed securities. Millionaires paid premium fees for catastrophic exposure. The fees continued even as the assets collapsed. 4. Social proof blindness. When your entire peer group, your golf partners, your country club neighbors, your brother-in-law the private banker, all tell you the market will recover by Thursday, you stay invested. Millionaires did not panic sell early. They panic held until the bottom. Then they panic sold. 5. The denominator effect. Millionaires who owned businesses saw their operating lines of credit cut by banks hoarding capital. Their businesses failed not because they were unprofitable, but because the credit markets froze. A profitable construction company with a $4 million backlog went bankrupt in 2009 simply because it could not meet payroll for 6 weeks while waiting on receivables. The modern relevance of this history is not abstract. The same structural conditions exist today. Margin debt is at record highs. Private market valuations are stretched. Correlation across asset classes remains dangerously tight, and the psychological machinery of social proof is still running at full capacity. Here is the uncomfortable truth. Most millionaires in 2008 lost between 40 and 70% of their net worth. But the ones who recovered did not do so because they were smarter. They recovered because they had one of two things. Either they had a stable cash-flowing business that was not dependent on credit markets, or they had a low-leverage, high-liquidity position that allowed them to wait. The millionaires who were truly destroyed were those who confused net worth with safety. They believed that because they had accumulated wealth once, they understood how to protect it. They did not. Accumulation and preservation require opposite skills. Accumulation rewards risk-taking, leverage, and concentration. Preservation rewards caution, liquidity, and diversification across uncorrelated assets. The doctor in Palm Beach, the hedge fund manager in Greenwich, the commercial real estate developer in Phoenix, they all made the same error. They assumed that the system that made them rich would never turn against them. But systems do not have loyalties. Markets do not remember past service. The crash did not discriminate based on who deserved wealth. It discriminated based on structural position. The philosophical ending is this: wealth is not a trophy you earn and then display. It is a dynamic relationship between your assets and the market's mood. In 2008, the market's mood turned from euphoria to terror faster than any balance sheet could adjust. The millionaires who survived were not the ones who predicted the crash. They were the ones who never needed to.